So thank you everyone who's joined us so far. This is the Food for Thought summer series. From last week's session, which was a long one, we're going back to the normal format, which is half an hour. We're very fortunate to be joined by Mikael Homanen, who's an ex-PhD student at the business school, and he'd worked with us at the Ethos, which is the Centre for Responsible Enterprise. And during that time, Mikael had done some great research looking at the role of responsible business in particularly the finance aspect. So he's a finance specialist and worked in financial issues for some time. He looked at issues about the Dakota Access Pipeline and the effect that's had on the cost of capital. And he spent time working at visiting stints at Wharton and Chicago business schools. And has presented his work everywhere. Now, Mikael's gone on to work with UN PRI, which is the UN Principles for Responsible Investment. And in particular, he's helping them to kind of shape their research strategy, providing evidence base around this new area where there's a lot of talk, but needs to be more evidence sort of inculcated into that. I should note that down the bottom it says 13 to 14:30. It actually should be 13 to 13:30, so it's not going to be too long. Before we go into Mikael's talk, I'd just like to highlight next week we're going to have a session on business, let's just say Boulder Dash, which is looking at the role of kind of loose talk in business, and I'll be doing that myself, and Caroline will be asking me questions about it. So I'll be looking at why people use this loose talk or empty talk in business, what we might do about it, and how to BS proof your business. So how to spot BS, what to do about it, and how to BS proof your organization. So today what we're going to hear about is some recent research which Mikael's been doing about the impact which the COVID pandemic has had upon business. In particular, looking at kind of a large data set of large firms and which firms have managed to do well, which firms have managed, which haven't done so well. What are the characteristics? What hasn't? So we'll hear from his work, which has been done with other people in the business school. I understand, and broaden out the experience, and you might have some questions from Mikael. So I'll take off these slides and then pass over to Mikael.
Yes, thank you so much for this invite. And full disclosure for the audience, this is still very much a work in progress. This is part of a much larger research project, and it'll be useful for me to hear what is it that people find interesting, and also more importantly, what is it that people would like to know more about? We know a lot more about these firms than what I'll be showing you today. We've done surveys before, and we'll be doing surveys in the future. So very much looking forward to the audience's thoughts on this. Now, this specific piece is highlighted by two main themes. It is emerging market firms, but it is how is it that they've been managing the crisis, and specifically the immediate reactions. In this COVID space, it seems like every day, yesterday's new, in terms of all the news that's coming, anything that might have happened a month ago is irrelevant because things are changing so much all the time, and we should all be wary of that a lot of this are just simply early insights from the crisis, and it remains to be seen what will happen. The motivation is rather grandiose. It's the emerging markets more so. We know Corona is devastating all economies in general, but it's the emerging markets that I was also worried about the most. These are vulnerable countries when it comes to their institutional strength, financial reserves, and a variety of other characteristics. So what we did is we surveyed firms in 10 emerging markets, and we complement that analysis with financial statement information. And again, just to stress the fact that everyone's getting hit when it comes to the disasters of Corona, both societally, but also economically, and emerging markets are getting hit more than others. At least those are expectations, and some early evidence also indicate that. And there's a variety of issues, as I mentioned, institutional strength, but that is one reason why it's important for us to try to understand at the firm level, specifically for them, how is it that they're reacting to this crisis? Because my early expectations on this project was that they were going to be hit badly. But so what is then the question? So that's a general expectation on my side, but the questions here that I hope I'll provide partial answers for today is, we're simply asking, how many firms got negatively affected by the pandemic. But what's more interesting is then to try to understand what were their business-centric reactions, employee-centric reactions, and stakeholder-centric reactions. And once we then know how they reacted, then our question is to try to also understand that the financial markets agree with that approach in terms of standard valuations. I'll give you a quick insight on the results with just this slide, and I'll provide a little bit more detail as we go when it comes to this 15-minute presentation. The main findings indicate a no panic scenario. So when we sent our survey, we did find out that 72% of these firms got negatively hit by the pandemic. And that kind of makes sense. We see that in developed markets as well, that firms are hit negatively. And when it comes to their business-centric reactions, if your revenues are hit, odds are you're going to have to scale down. And you see that quite high number, which is 56% of them reduced investment spending. That is what wasn't too surprising for me. What was surprising for me was kind of the rest, because these are, as I mentioned, vulnerable markets. So if I'm operating in this environment, I imagine myself being extremely cash constrained, and I, as a result, because of general economic downturn, have to fire people as well as do everything else I need to survive as a business. But luckily, that doesn't seem to be the first set of responses. We see that approximately, and I say only, that's of course relative, 4 to 8% of firms made any layoffs. So it's quite a low amount, and I imagine that those that did make those layoffs are those that really had to. So it's just a few. In addition, we asked a variety of questions on stakeholder-centric reactions, and 98% took measures to protect stakeholders. So virtually everyone was helping someone. I have in the end some anecdotal evidence from the qualitative responses as to what that means. But to just clarify a little bit more, we see that around half of the sample continued paying employees and vendors when businesses were disrupted. So as anecdotes have shown in developed markets, we've seen that a lot of organizations and households continue paying for cleaning services, for example, even though there's nothing to clean in the office space. So it looks like such similar reactions were made in emerging markets as well. And surprisingly, 83% of these organizations made donations to fight the pandemic. So it's a surprisingly strong stakeholder-centric response for these markets. And then to add a little more insights on the last question that I mentioned earlier is what were the financial market reactions? We do see that of the first two questions at the top, financial markets were valuing them negatively, as makes sense. You value these very traditional fundamentals. You get hit negatively on the revenue side or anything else, financial markets will downgrade the price. Surprisingly, in the regressions, we see that these stakeholder-centric responses were not significantly correlated with any excess punishment by the analysts or, investors. And same goes, we have a few where we actually see that they were being hit less. So they were significantly likely to have higher stock prices, or let me be clear, less negative during the market downturn. I'll go to that more in just a bit. That's really the main insights. So how did we get to this? This was with Burton Flynn, who's a portfolio manager of a Finnish-based emerging market fund. So this was a multi-year ESG survey design project where we're going one country at a time, interviewing CEOs and companies, CFOs, IR personnel. Corona kind of stopped that. So by the time Corona came, we had reached 10 markets and that had done 10 markets worth of ESG survey collection. Now, when Corona started, we decided then, okay, now we need to understand what is it that the firms that we had already contacted, spoken with, and have data for, let's get back to them and try to understand, because we've established this connection, how is it that they are managing the Corona crisis or COVID crisis? And so we reached out back to the 623 firms that had already responded to some of our early surveys and or early contact. And basically, we sent them 13 questions, of which 488 of them responded. These are listed equity companies, and they are very sizable. They represent sizable stakes of these economies. We have Bangladesh, Indonesia, Malaysia, Pakistan, Philippines, Saudi Arabia, South Africa, Thailand, Turkey, and Vietnam. This is where the sample of firms exist, those 488 that responded to this survey. And so instead of showing general summary statistics, I'll show you a few graphs of something that I already mentioned. First is simply who got hit negatively. you'll see that this is across countries and across sectors. So there is a little bit of variation, whether the company was in Bangladesh or in the IT sector, but you do see that on average, no matter where these emerging market firms were, they were being hit negatively, both across countries as well as across sectors, with nonetheless some variation. On the second question, you'll see that a sizable amount of them started reducing their investment spending, and that fairly high value is across these sectors and countries. So everyone's getting hit and everyone's adjusting their operations to reflect that new crisis. But this is where it got surprising for me at first. So we saw that between 4 and 8% of these firms, even though they're getting hit very negatively, they're reducing investment spending. But the last thing that they're doing is actually firing anyone. So there's a lot of employee-centric reactions here. It seems like it's almost like a last thing that a firm would do is to want to fire its employees, especially during a time of crisis. And to put the other lens into this, you'll see that whether it be making donations, taking measures to protect stakeholders, continue to pay employees or vendors if the service was disrupted, rather high values across the board, and across firms, across countries. It seems like everyone was trying to be the good person during this crisis. So it's quite a stark contrast. These are just the summary statistics, basically to say what I just mentioned. I'll give a few insights before I go into the financial reactions, because part of this research, I don't have too much to say today, but part of what we're trying to understand is what are the drivers that drove these firms to act responsibly or to take these stakeholder-centric reactions. One thing that was surprising here in this regression was that I expected that over time, as the crisis took longer and longer and longer, firms to then take less measures to protect stakeholders. This particular regression is about the time since lockdown was implemented, strict lockdown was implemented in that country. We actually see that the longer the crisis takes, its evidence seems to say it's actually opposite, that then you're even more likely to take care of stakeholders. Wouldn't want to say that's the main message here, but it's at least not the opposite, which would be firms would be less likely if the crisis keeps going on. So it's at least in this time interval, people are sticking to that decision or dedicating themselves even more as the crisis continues. There's other factors that I wanted to investigate, but don't have too much to say, which is, are these firm-specific reactions or are these characteristics that are associated with norms and country-level factors and macroeconomic factors and things that everyone does? So looking at an R-squared analysis, and when we put firm-level controls, we see that these firm-level factors actually barely influence the likelihood to these firms to, in this case, make donations. It didn't really matter which firm you were, those didn't matter as much. Whereas if you put in these country-level factors, which capture a lot of things, institutional norms, expectations, macro, lockdown policies, it's hard to say what's exactly driving there, but at least it's saying that it's these bigger picture things that drive the corporate behavior more so, not really which firms can afford it, or which firm was a good guy, or high ESG or high socially responsible firm beforehand. Again, this is just early insights. And then these are the regressions on the cumulative returns. So the dependent variable is the cumulative return of that specific stock, so at that firm. And this is between February and April, when the crisis was at its worst. The S&P 500 and the indexes were going down, and we're trying to look at the survey information we got, who was getting, what factors further contributed to that downturn. So you see things that you would expect. The firms that have to reduce investment spending after controlling for country level factors and other traditional metrics at the firm level, like firm size or leverage, the ones that had to also reduce investment spending were further negatively valued by the stock market. Again, very traditional kind of as expected regression. But then I simply wanted to know, okay, a lot of these firms are taking measures to protect stakeholders, making donations. So is the financial market then thinking this is a negative? Is it a cost? And surprisingly, in the early days of the crisis, it looks to be the other way around. I don't want to push that overgeneralized message, which is if you do high CSR, you get high returns. That's not you can't put that into one regression, but it does seem to indicate that those firms that made these stakeholder-centric long-run decisions when it comes to their business relationships and factors that affect broader society, the stock market's actually in the downturn valued it positively, but at least didn't punish more. So these weren't seen as value negative factors by them. So they seem to have agreed with the choices by the firms. If you're interested in a bit on the anecdotes, this is something that we're trying to look more into at the moment. We have a lot of qualitative responses from these hundreds of firms, and this will just give you some insight, because it's one thing to say I protected stakeholders, but it's not really sure if you're actually making any substantial measures. So here you'll see that, for example, an Indonesian lifestyle retailer shifted their garment factory to make masks and PPE equipment for medical professionals. A South African self-storage asset owner and operator made its properties available for no charge for NGOs for the storage of coronavirus-related supplies. So if you think about what developed market companies have done, it mimics quite a lot of the similar story, but it's surprising that a lot of these firms were there using their assets in a way that was relevant, even in these markets. It seemed that to a certain degree, they were at least afford to do so, and most of them did do so in a way that actually mattered. I'll end by just this conclusion, just saying that the early insights from our surveys indicate that there was no corporate panic, at least not yet. We need to be careful with our expectations when it comes to these firms, because everything's still in question. How long are these lockdowns going to be implemented? How are businesses going to survive? Are they going to get bailouts? Everything. But at least when it comes to the first month's worth of evidence, we didn't see any major corporate panic. And surprisingly, we actually see a lot of them making a lot of stakeholder-centric responses, at least for now. That was the immediate response. Long term will, of course, remain in question. And surprisingly, financial markets seem to agree with the stakeholder-centric responses, or at least not punish them. I'll end with that. Thank you so much. This was a real pleasure, and I'm looking forward to any comments and questions.
Great. So thanks very much for this presentation. Well, the first, I should note that people, if they have any comments or questions, please put them in the chat. I notice we've already got a few, but please, if you have any thoughts, put them in the chat. I'll just kick off with one obvious question, which is, what about sort of developed countries? How does the developing context compare to developed economies? So for instance, I know that the research which has already been done tends to show that during large-scale economic downturns, it's firms which invest in CSR and innovation, but also cut variable costs, tend to do better during those times. I wonder if you've got any kind of comments from the work which you've seen in developed context versus developing contexts.
Absolutely. Do you mind if I answer that now?
Please answer, yes.
Yeah, so this is something that we've actually talked about quite a lot. There's a lot of research coming from the finance community showing that firms that were before the crisis, high ESG, so high CSR, or had higher levels in terms of their factors are environmental, social, and governance. You see that the stock returns during the crisis were higher. So that means that there was something fundamental about these firms that made them more safe in the long run from a financial sense. But that was before Corona. What I've been conjecturing recently is doing good ESG or CSR before Corona is also very different from the ESG and CSR you do during Corona. And those are different things. So at least it was good to know that for developed markets, we know that these firms are better also during crisis, and we had some evidence of that. But in this particular study, what's really nice is we'll complement our analysis in the future by using pre-existing ESG characteristics, CSR characteristics. But that's not what we did here. What we're really adding is we actually know their responses. I'm as of yet don't have I have not seen a good paper on developed market firm level reactions. So whether they've been actually codified to understand how they really took care of stakeholders as opposed to putting a few things on their website. So in this case, we're a very, very novel opportunity. Not only do we know how they actually acted when it comes to the CSR on a crisis, but also how that was valued. Luckily, that was valued positively too. It wasn't just what they did before. And in the future, hopefully we'll learn a little bit more as to whether the pre-existing characteristics mattered for that equation.
Okay, thank you. So we've got a question from Palavi. can you expect asset managers to bake in ESG considerations more actively into their investment strategies in developing countries where there are little or no social security programs?
So that is a difficult one because it depends on what is it that you're actually looking at. So I'll start from a big picture answer first. Please, Andre, clarify if you think I'm not answering this perfectly or even a little bit. One thing we were trying to understand if these firms took stakeholder-centric measures before the government. And we saw a lot in our anecdotal survey responses that these firms stated that our governments do not have the capacity to take care of stakeholders. The institutional strength is not there. We as a firm are the only thing that can respond and take the measures to protect the stakeholders, whether it be masks, whatever was relevant in that particular market, including taking care of employees. There's no bailout package for the employees in that market. It's left to the firms to make sure people still have a job. So there were some early questions we were trying to understand whether governments were complementing this relationship, but at the moment we do not have enough heterogeneity or variation to say whether these firms acted with the government or acted more because the government wasn't there. And then the next question becomes, okay, where is it that as an asset manager you want to bank when it comes to these ESG factors? So before, as I briefly mentioned, these ESG factors were correlated with returns, but that doesn't just mean you can make more money with them. There are climate risks. There are things that do add value, such as taking care of your employees. So you got to keep your eye on all these things. But the emerging markets in general are a much more difficult environment to understand these factors because each factor's value is very different. ESG data providers quite often don't cover these companies. Relative to the MSCI world, these guys are small. And some of our preliminary data also show that a lot of the firms we're looking at are not covered by the big MSCI and other ratings providers. So if you want to understand more of this firm, I would suggest also reading what the Terra Nova Capital does, which is a lot of anecdotal evidence on what as an investor you need to try to understand, because what I've seen in the short history, there's a lot we don't really know about investing in CSR in emerging markets because of the lack of transparency, trendization in data, as well as even data available through data providers. So there is a lot to be done, but I don't want to say as in what should you do and potentially make money on.
Thank you. We've got a question coming from Sebastian, which is, he'd just like to thank you for this great work. Then the follow-up question is how multinationals, which are providers to small business and emerging economies, can help them recover from the COVID crisis, and particularly he's interested in the IT sector.
This is, I'll admit, this is going to be a gut reaction. I haven't thought about this a lot. For broader context, if anyone's interested, PRI has been providing guidance for large investors as to what they need to be looking out when it comes to corporate behavior and expectations to manage this crisis from a sustainability perspective. So there's a lot of difficulties there. There's a lot of things to do. And when it comes to the expectations on multinationals, I believe there's an expectations for large established multinationals to make sure that they are there for their supply chains. So if their supply chains, which are mostly in emerging markets, are getting hit more, I would hope so that they would keep these long-term relationships prioritized, provide that financial flexibility. My anecdotal evidence would indicate that that's exactly what these large multinationals are doing. I don't have the academic evidence to support that argument, but we know in general that these social responsibility of supply chain management extends from developed markets to developing markets. And I currently don't see any reason for firms to start punishing these emerging markets, given that they've already tried before COVID to provide the support because of climate change issues and anything else. So I would conjecture that those activities are still very much there. On the IT sector specifically, I imagine that there's a lot to be done. Emerging market literature will probably give us a better understanding in the future as to like what institutional characteristics allows an economy to survive, including firms. And I imagine that those that have better broadband connection, as well as other infrastructural developments on IT-related matters, are the ones that are going to survive. Now, if there are other larger firms that can help emerging market firms, and also potentially households, I would hope so that this is a value-adding long-term investment that large firms should and could make from both business, but especially from a societal perspective. But I don't have more to add on that specifically.
So two more questions. So one is that someone's asked that you had a kind of sample, I think it was 7 or 8 countries. What about other large developing countries, such as in particular India? Have you got any kind of sense from other research or anything about what's happening in those other contexts and how comparable your sample is to the wider sort of set of developing countries?
Unfortunately, the optimist in me would, of course, want to say that our sample is representative of everyone else, but that will never be true. This is a unique survey because it was us through a fund manager approaching firms directly, and most of them did answer us. So it was very luxurious of us to get this response rate. Now, if there are characteristics that you believe that are connected with the Indian sample, either in terms of norms and or firm structure and or sector characteristics, there might be some extrapolation that you could do. So if you think either Indonesian or Malaysian or other companies or countries here are very similar in structure, I would expect the same characteristics. Because as you can see from a lot of the reactions, they are very similar in terms of the broader magnitudes. Though there's differences across countries, at the moment, I don't expect them to be drastically different unless that country has a significantly different lockdown characteristic. And that is something one would need to understand more of as well. We didn't see the lockdown equation mattering as much for these particular questions, but we've learned in the long run that a strict lockdown policy in terms of standard revenues is going to be extremely damaging. So given I don't know exactly how Indian companies have survived, we know from prior literature, because of legislation and other issues, that they are very pro-CSR. Hard to say what the magnitude is exactly. So I would guess that it's going to be a very similar story, but unfortunately I don't have any more evidence to provide.
Okay, so I think we're probably going to need to wrap up at that point, but I've got one sort of final, very general question for you. You work for the PRI. Can you tell us a little bit about what the PRI is about and what, I know you've been adding a lot of new resources on your website. Maybe you can say a little bit about that too before we close up.
Oh, thank you for saying that. So I work for the Principles for a Responsible Investment that currently represents over 100 trillion US dollars of investment managers and asset owners. And this organization historically has been bringing investors together to assist them in transforming their portfolio companies into more sustainable, to enact more sustainable practices. You can think anything from water risk management to plastic pollution to tax transparency to methane emissions. That's what the organization has been doing historically. And what I've been recently there doing is creating further expanding the academic research department. So this is a rare opportunity for me to show firm level evidence. In the future, hopefully I'll be able to provide a lot more guidance from the financial sector's involvement when it comes to social responsibility by bringing data from thousands of investors to better understand who's actually changing their companies and who is not, is hopefully some of the additional information we'll provide through this research department. But if there's other interesting things that the audience might care to see, is we provide a weekly academic blog. So we have professors contributing by showcasing their own academic papers in a reader-friendly fashion. We do podcasts, and we provide a lot of academic tools and data for both investors, academics, and students. So if you're interested in tools where you want to understand more about the academic literature on these topics across disciplines, or the databases that those disciplines use, we provide a few tools on the website.
Okay, great. So I think your office, even though it's closed now, is sort of just 500 meters or something from the business school, right?
Yep.
Okay, so thanks everyone for joining us. Thank you very much, Mikael, for this great overview of companies' responses to to the coronavirus, and we'll see you again next week. We have a seminar on business bullshit from me, and then subsequent weeks we'll announce what's coming up. So thanks everyone for joining, and we look forward to seeing you again. Thank you.
It was a real pleasure. Thank you.